In the previous lecture, we discussed business operations and business intelligence decision making. In this lecture, we will talk about business planning and management objectives. Let's begin with management by objectives. So what is management by objectives? Management by objectives, MBO, is a strategic management model that aims to improve organizational performance by clearly defining objectives that are agreed to by both management and employees. The term management by objectives was first outlined by management guru Peter Drucker in his 1954 book, The Practice of Management. According to the theory, having a say in the setting of business goals and the action plans to achieve goals would encourage participation and commitment among employees, as well as aligning objectives across the organization. In this lecture, we will leave MBO, the management theory by Peter Drucker, alone. Instead, we will deal with the management of objectives, or more specifically, business objectives in the management of business operations. All business operations must be managed with the aim to achieve business objectives through the execution of a plan, which is called the business plan. In our previous lecture, we talked about some of the most common functions that managers carry out to manage business operations. These are strategic planning and forecasting, analyzing market opportunities and trends within the business, monitoring benchmarks and performance data, defining end-to-end cross-functional process, identifying and tracking key performance indicators or KPIs critical to the health of the teams within the business. By carrying out these functions, managers generate plans, and then they manage the business operations according to these plans. In other words, managers make business plans and then they implement these business plans. Here is an example of a plan. A plan can be a strategic plan, a tactical plan, or an operations plan. In other words, business plans are formulated at three different levels. An operations plan is a lower level plan that supports the tactical plan, a mid-level plan, and which supports the strategic plan, a high-level plan. What are the differences among strategic, tactical, and operations plans? A strategic plan is a business plan created by an executive management team which has a much wider scope than a tactical or operations plan. It is a plan that outlines the ambitions, future goals, and mission of an organization. Strategic plans may focus on the high-level and long-term goals that the business will work to achieve over the next 3 to 5 years. Strategic plans tend to be much broader and rather vague. A tactical plan is created by mid-level management professionals and includes the specific actions that employees must take to work toward the goals described in the strategic plan. Tactical plans outline how a certain area or department of a business will support the strategic plan over the next 1 to 3 years. A tactical plan will include more specific ideas and actions, but may not be in a lot of details. An operations plan focuses on specific departments and their roles in achieving short-term goals. A specific department, say for example, the sales department, may create an operations plan for the sales team to implement the processes needed to achieve the sales goals outlined. When team members are involved in creating the plan, they are often more likely to work together to accomplish the necessary tasks. Now let us focus only on the operations plan. An operations plan provides more details about how a specific department or a team will achieve the goals, which are set for this specific department in the high-level plans. It is important to note that an operations plan is about the day-to-day operations of the business. An operations plan only applies to a specific area of business operations. For example, for a manufacturing firm, an operations plan might outline actions for each of the products it manufactures and sells, or for each of the plants it operates. For a retail firm, an operations plan might outline actions for each one of the products it sells or for each one of the outlets it operates. Operations plans can be further segmented into two categories. The first is a single-use plan, which is created to address a specific issue or period. An example of a single-use plan is one that outlines the process of a sale promotion for the next season. The second category is an ongoing plan, which will carry forward in many cycles into future time periods, but can be altered as needed over the long period specified. An example of an ongoing plan is one that outlines the process of retailing a product, in the case of a retail business, or the process of the manufacturing and marketing of a product, in the case of a manufacturing business. What are the important business objectives in the management of business operations? For the management of the day-to-day business operations of most businesses, there are 5 very important business objectives, be it a retail business, a manufacturing business, or some other business. They can be represented by the acronym SIREN. And they are share, inventory, revenue, expenses, and net profits. Let us look at these 5 objectives one by one. The first of the 5 SIREN objectives is share. Share refers to market share. Market share is used to give an idea of how large the business is within its particular sector. Market share of a business or a service is calculated by taking the total sales and dividing it by the total sales of the entire sector or market for this particular product or service. Market share is a key indicator of market competitiveness. It enables managers to judge total market growth or decline, identify key trends in consumer behaviors, and see their market potential and market opportunities. Market share increases can allow a company to achieve greater scale in its operations and improve productivity. A company can try to expand its share of the market, either by lowering prices, using advertising, or introducing new or different products. In addition, it can also grow the size of its market share by appealing to other audiences or demographics. The second of the 5 SIREN objectives is inventory. Inventory is an accounting term that refers to goods that are in various stages of being made ready for sale, including final goods that are available to be sold, work in progress, meaning in the process of being made, raw materials to be used to produce finished goods. Inventory is generally the largest current assets a company has. Why is inventory important? Inventory refers to items that are expected to be sold within the next period, if it is a finished product, or items expected to be used for manufacturing within the next period, if it is raw materials, or items that are in the process of being made, which are called work in progress. The next period can be a month, a quarter, a year, or even longer. Zero inventory means there is nothing in stock to be sold, or nothing in stock to be used for making products. This cannot be good. It means market potentials cannot be captured. However, too big an inventory cannot be good either. It means there is too much stock not sold or too much stock not used. In the previous lecture, we talked about dead stock, which refers to products that the company has in stock but that are not in high demand. An important characteristic of inventory is that it must be maintained at an optimum level by periodical replenishment. How does inventory synchronizes the supply and demand of a product? As shown in the figure, a business works according to an operations plan. Potential demands are continuously met by inventory available and production for the next period. Potential demands are determined by factors such as economic status, product life cycle, price index, and seasonal factors. The ability of the business to meet potential demands is determined by the investment and maintenance of production capacity and the maintenance of an optimum level of inventory. The third of the 5 siren objectives is revenue. Revenue is the total amount of income generated by the sale of goods or services. A high market share leads to a high volume of sales and naturally leads to a high level of revenue. This is obvious. However, what is not obvious is whether it is a good thing. With a high market share and high revenue, the business could be making huge losses because the product is sold at very low prices. To secure the high market share, high volume of sales, high revenue, such that the revenue cannot cover the costs of doing business. Therefore, a high or low level of revenue cannot be judged as good or bad without considering the next 2 of the 5 siren objectives. The fourth of the 5 siren objectives is expenses. Expenses refers to the cost of operations that a company incurs to generate revenue. As the popular saying goes, it costs money to make money. There are 2 main categories of business expenses in accounting: operating expenses and non-operating expenses. One of the main goals of any business is to maximize profits. This is achieved by boosting revenues while keeping expenses in check. Slashing costs can help a business make more money from sales. However, if expenses are cut too much, it could also have a detrimental effect. Advertising, investment in production equipment, maintenance of inventory are expenses that cannot be cut too much, for example. It costs money to make money. The final one of the 5 siren objectives is net profits. Net profit is also called net income. Net income reflects the total residual income that remains after accounting for all cash flows, both positive and negative. In other words, from revenue, which is called the top line number, all expenses and costs are deducted to arrive at net income. Measure the siren objectives. In the previous lecture, we learned that the 3 key activities that a business must carry out to improve business operations are measure performance, keep up with the latest trends, and streamline processes. Measure performance is at the top because the manager, individually and solely accountable to a specific operations plan, must first of all find out how the business is performing in order to improve it. That means the manager must measure how well the operations has been carried out in the achievement of the siren objectives. To do that, the manager collects data on the key performance indicators, compare the actual performance against the business objectives. The manager then decides on remedial actions to be taken to meet objectives in the next period. For example, if the manager finds out that share of the market is below the objective, inventory is above the objective, revenue is below the objective, expenses is above the objectives, net profit is below the objectives, then the manager must determine what are the reasons that these are happening and what changes must be carried out to improve the performance to meet the business objectives in the next period. Measurement of the siren objectives is done month after month, quarter after quarter, year after year. In the next lecture, we will talk about the financial data that are important to business operations, which are related to the 5 siren objectives, obviously, and how to interpret this data to understand the performance of the business and to determine what changes can be made for the improvement of the business operations. I will talk to you in the next lecture.